Good afternoon, good morning, good evening to our members wherever you are. I appreciate we still have a few people that are in the process of joining the webinar, but we'll get started. I'd like to introduce you to VAM Funds Director, Rob Gordon, and Business Development Director, Stephen Redway. And today they are going to present to us new offers that correct your US small cap fund. So over to you, Steve.
Thank you, Sarah. Much appreciated. Thank you for organising this. First of all, just welcome everybody. A little bit of background on VAM Funds. We were established back in 2001. We're a Luxembourg investment management company with over 500 million funds under management. So we offer a range of direct equity and multi-asset funds from Luxembourg. And we don't actually manage any money ourselves at VAM Funds. We outsource the investment management to specialist firms in their field. And we work with Driehaus Capital Management, who run our pure equity funds. We work with Atomos, who run our multi-asset funds, and Foresight, who run our infrastructure fund. Today, we're going to focus on the VAM US Small Cap Fund, which is run by Driehaus Capital Management in Chicago. And it's our longest running fund. It was established back in 2001. And it truly is a spectacular fund in its field, and will have a real positive effect held within a portfolio. And I'm delighted today to be joined by Rob Gordon. Rob Gordon is actually an ex-CEO of Driehaus Capital Management, where he ran the firm for over 10 years. Rob joined VAM Funds 4 or 5 years ago and is a senior director within the company. So today we're going to focus on the VAM US Small Cap Fund, but obviously if you've got any other questions at all about any of the other funds within the range, then please contact me direct. So over to you, Rob. I'll just share the presentation.
Thanks, Steve. And because we're kind of an intimate group here today, feel free to ask any questions as we go along. We don't have to wait till the end of the presentation. If there's something in particular you'd like Steve or I to drill down on a bit more, please feel free to submit your question. Okay, Steve, want to move ahead to the next slide? Great. No, I'm sorry. The backup one. There we go. Okay, good. All right. So the way I've framed this discussion, this presentation today, is around 3 quotes. I try and think about from your perspective, concepts, ideas, themes, even things that might be slightly humorous as a way for you to take information and then present it on to your clients, to your investors. So I framed this presentation again using 3 historical quotes. One of them is contemporary, the other 2 are historical, and I'll use them again as a way to frame the topics. Steve mentioned that the presentation is about presenting VAM's Small Cap Growth Fund, which we'll certainly cover at the back half of the presentation. But I thought it'd be useful first just to set a backdrop on the U.S. macro environment. Lots of conversation on the Fed, right? We're hearing about that every single day, and the impact that has on the markets, with inflation a key driver, and what that means for 2023 and 2024 from a market perspective. I'm also going to talk a little bit about the impact of U.S. politics on the economy and markets, because hardly a day goes by where I don't get asked, well, what does it mean to have a split Congress? Is Donald Trump going to run again? And what does that mean? And then, of course, as Steve mentioned, we'll focus on the U.S. small cap growth fund. So this first quote: "Strike an enemy once and for all, or he will live to fly in your throat." And you're probably wondering, where did this guy come up with this quote, right? I'm a bit of a student of military history, including African military history, and I forgive those who aren't. But this was a quote from the great African king Shaka Zulu, who was king in the 19th century, and he was a brilliant king, brilliant military strategist. He created short offensive spear that he's holding there, as well as the shield. He invented the military strategy called chest and horns battle formation that allowed him to be the great ruler that he was in Africa, the Zulu people. But he was also famous for this quote, and its bloody consequences. And what he meant by this when he said it, and it may be slightly paraphrased, is that no enemy, he would leave no enemy on the battlefield, because his feeling was that if you left a wounded enemy on the battlefield, then that enemy could rise again and ultimately be victorious over you. And while the U.S. Fed Chair Powell, who's the gentleman on the right, hasn't quoted King Shaka, he certainly has made clear his plans for inflation, which is the proverbial spear through the heart. And I think, we've seen that the market keeps looking for signs that the Fed will pull back or slow down on interest rates, and maybe engage in what's called the Fed pivot, where they'll chicken out and pull back on rates or pause on rates. And that's why we've seen some of this market volatility. The market continues to look for signs that the Fed won't fulfill on its promise to truly put the spear through inflation once and for all. But I think the market's making a mistake when we see those those days of up rallies based on some kind of Fed indication that maybe it's going to slow the pace, or it's going to stop raising rates, or that there might even be a pullback fourth quarter or early next year. And I think it's important to remember where Powell is coming from. The Chairman Powell and the Fed got it wrong early on in inflation. I think we all did. You may remember there were these conversations about, inflation is just transient, right? It's just really a supply chain problem. And as soon as the proverbial kink in the supply chain disappears, then inflation will disappear, and we'll go back to sort of what we've had in the past decade of technology really eliminating the concept of inflation. Well, the Fed has vowed not to get it wrong this time. And I think what we saw with yesterday's market action of the Dow down over 500 points, that the market's finally getting the hint that the Fed is serious about inflation. A little history, I'm guessing that those on the call may not remember 1975, when inflation dropped to about 5%. And the Fed thought, okay, well, we've done our job, and they took their foot off the gas. And by 1980, just 4 or 5 years later, inflation was up to 15%. And you may recall the inflation of the 1980s, when you were getting 17, 18% on a long-term CD. So Powell won't make that mistake that prior Fed chairs have made. And then, of course, we're also seeing that inflation is extremely stubborn. It sits in the U.S. at about 6.4%. And it's extremely sticky. And you've got global events like Ukraine and China's post-COVID recovery that continue to make it sticky. We have full employment in the U.S. We're stuck at around 3.5%. There's currently 2 jobs open for every potential working person in the U.S. So this is going to be a higher for longer Fed, if you will, and that has an important implications and ramifications for the economy, and certainly the markets. So let's take next slide, Steve. Let's take a look at we all hear about this headline inflation number, core inflation of 6.4%, and we say, okay, well, 6.4%. Fed wants to get it down. They say 2. They'd probably be happy with 4. So we're really not that far away, right? But if you really look at what the consumer is dealing with right now, and in the U.S., as we know, 70% of the U.S. economy is driven by consumer spending, just what kind of inflation the U.S. consumer is really dealing with. The face in the middle, a Mickey Mouse pancake. For those I wish we could do a show of hands, and I would ask how many of you have been to Disney. But for those of you who've had Disney in Florida, it's the most visited theme park in the world. In last year, the theme park had almost 13 million visitors, and that's an increase from 6 million visitors the prior year. And just to give you an example of inflation, that simple Mickey Mouse pancake that you could probably make at home for about 15 cents is over $20 at Disney. So that's really inflation personified. On the left, you see a bag of basic garden fertilizer. And fertilizer, as we know, is one of the key inputs for food production in the US and globally. And the cost of fertilizer has gone up several 100%, and that could see food prices increase in the US in 2023 by as much as 80%. So again, forget 6.4% headline inflation when you're seeing food prices increase by as much as 80%. Another example in the US would be purchasing a new car. It used to be, you had this sticker on the windshield of a new car in the lot called the MSRP, or manufacturer's suggested retail price. And of course, no one ever paid that, right? You could negotiate with the dealer several $1,000s off of that price. Now in the US, for a desirable new car, you're paying as much as 10% over the MSRP. So just dramatic inflation across those three categories. Just some other examples. Eggs in the US are up 60%, butter's up 31%, lettuce is up 25%, airfare's up almost 30%. So we're really dealing with strangling inflation of the US consumer, who is really struggling to maintain sort of that 70% impact on the US economy. Yes, we're starting to see, you're seeing headline news about tech companies like Amazon and Facebook and Microsoft and Google, and in the financial sector, Goldman, Citi, Morgan Stanley, et cetera, they're all announcing layoffs. But the service industry is still holding tight, and that's where a lot of the jobs are migrating. So really important factors to watch are not just these sort of headline news layoffs in tech and financial services, but really focus on that job number, and that'll tell you where inflation is. So again, the punchline there is that the Fed's going to continue to keep its foot on the gas as it relates to inflation. No Fed pivot soon, and that's going to keep a sort of pressure on the economy. Keep the notion of possibly a recession in the headlines, and that the Fed is really committed to softening financial conditions. So the Fed wants to see a weaker market, not a stronger market. They want to see higher rates, not lower rates. They want to see it more expensive to get a mortgage, not less expensive. So the key impact that this could have, of course, could be a decline in earnings, and the primary driver of stock market appreciation is earnings growth. And so this is something else to keep an eye on. I would say the two key factors to keep an eye on for the rest of this year are US unemployment statistics and corporate earnings. Okay, Steve, let's take a look at the next slide here. So I wanted to spend a minute on US politics and the impact of US politics on the market. I get asked frequently, we hear a lot about the war between the House and the Senate and the Democrats and the Republicans. And this is just a slide, screenshot from CNN from our last congressional elections. And what it shows at the top between the Senate and the House is we've got a Senate that's now controlled by the Republicans by a seat or two. And on the House of Representatives, the Democrats control the House, again, by a handful of seats. And as you know, we have a Democratic president. So what does all this mean? It really means we have a stalemate in US Congress. And that's actually a positive for the markets and the economy, because we all know that politicians don't tend to be particularly helpful with legislation when it comes to the impact on the markets and the economy. They like to raise taxes or lower taxes or put new regulation in place. And by having essentially a stalemate in US government, we can essentially take that factor out of pressures on the markets and the economy and just focus on the true fundamentals of the economy that will drive markets. Steve? Let's go to the next one. So just a quick comment on this handsome devil here. You may recognize him as the eponymous Donald J. Trump. He has announced that he's going to run in the US 2024 presidential elections. So I'll tell you now what's going to happen. So he's going to win the primaries. He's going to become the designated candidate for the Republican Party. At age 79, Joe Biden at age 80 will be the Democratic nominee. So you're essentially going to have two octogenarians who are fighting it out for U.S. president. Biden will win the general election. Assuming he's still in good health, and we'll continue to have a divided Congress, a Democratic president. So probably not much of an impact again on the market. So you can kind of dismiss U.S. politics from what's going to happen and really focus our attention on the Fed and on interest rates and corporate earnings and unemployment. Those are going to be the big drivers for what happens during the rest of 2023 and into 2024. So that's just sort of a quick overview of from a global perspective. Now let's jump into the VAM Small Cap Growth Fund. And this last quote that I have is by a German-born British economist named Ernst Friedrich Schumacher. And you may have heard the phrase before, small is beautiful. Well, that actually came from Mr. Schumacher. And his whole thesis behind the concept of small is beautiful. And again, he was an economist. So his concept was, and not too terribly complicated, was that large breeds lethargy. Large companies are lethargic, they lack ability to innovate, and they consume a lot of resources, and they're extremely wasteful. Small companies, on the other hand, his thesis was small fosters innovation, it conserves resources, and it's nimble. And if you think about in the US, some of the big tech companies, the Microsofts, the Googles, the Apples, et cetera, where their innovation comes from is actually from teams that they lift out from other companies or small companies that they actually acquire. Looking at small businesses, 50% of the US employment is in small businesses, which is kind of a surprising statistic to many people. And that when it comes to innovation, new innovation in large companies typically has only about a 20% chance of being around in 5 years. New innovation in small companies typically has a 50% chance or greater of being around in 5 years. So it's really in small companies where the action takes place. Let's take a look, Steve, at some proof statements there with what happens from a market standpoint. So this slide takes the last 6 recessions: the 1980 recession, 82, 91, 01, 09, and 2020 recessions, global recessions. And then it looks at data for the Russell 2000 growth, which is the index for small cap equity investments, and the S&P 500, which we all know is for generally large to mega cap. And it looked at what happened to those indices 12 months after a recession. So if you think about my prior comments about the Fed and the economy and an increasing probability that we're going to find ourselves in a soft patch, anywhere from a soft landing to a recession, and recognizing that equity investing is a long-term game, right? We're not going to try and measure results just based on, say, a rough patch in the markets over the next 12 months, but might look at what happens after the recession is over. And because recessions are generally short, 12 to 18 months. So how should we be thinking about investing coming out of the potential recession that we might have? And this shows you that small caps are an extremely important part of one's portfolio coming out of a recession, that they're the big movers. They're going to have the accelerating earnings growth coming out of recessions, and they significantly, by a factor of over 100%, outperform large cap equities. So I think it's a striking contrast to, while certainly the broader market does well coming out of a recession, small caps do extremely well as they have that sudden burst, that acceleration in earnings growth post a recessionary environment. Okay. So this takes a look at, I talked about generally small caps. And by the way, but before I get into the VAM small cap performance specifically, talk about the timing for small caps. So it's certainly we have that history of earnings acceleration and positive returns coming out of a recession. But this is also a historically significant time to be considering small caps, because typically they trade at about a 5 to 10% premium to large caps under most normal market periods. Now you have small caps trading at about a 20 to 30% discount to large caps. The PE on the small cap index is about 13 right now, 13 times. And on the S&P 500, it's about 18 times. So you have this historical cheapness in small cap equities that we really haven't seen in decades. And in fact, as we talked to Driehaus, our manager, on their view on some of the stocks that they're holding in the portfolio, they're almost giddy. They're seeing stocks trading at 1990s recession lows in the small cap space. So onto the fund in particular, we talked about the outperformance of the index versus the S&P 500. Then if you look at the VAM US Small Cap Growth Fund versus its peers versus other small cap funds, you can see the dramatic outperformance of the VAM fund versus other small cap peers. 52% over the last 5 years for VAM US Small Cap Fund versus a 38% number for the peer group average. So great returns for the category, but this is a space that we would encourage picking a good active manager like the VAM US Small Cap Growth Fund, which has a history of significantly outperforming its index and the peer group. So let's take a quick look at some of the companies inside of the VAM Small Cap Growth Fund. What we're used to looking at in portfolios are large household names that we all recognize. And it's a very efficient space in the large cap space. In the small cap space, it really takes exceptional research capabilities because these aren't household names. And in fact, Wall Street, as analysts, pays less attention to small companies in terms of their research, so misses out on these opportunities. And the reason that Wall Street misses these opportunities is because there simply isn't enough order flow. They can't make enough money trading these names because there aren't enough shares outstanding. There's not enough volume in terms of stock trading. So they typically don't pay as much attention. And that's a great asset for an active manager because this is where they can really discover opportunities from an investment perspective for the portfolio. So my guess would be that most of us on the call here don't recognize these names in the portfolio that have exhibited over the past 6 months just tremendous returns inside of the fund. And that's a positive thing that we don't recognize these names because that allows the expertise of Driehaus Capital to really discover some great earnings growth opportunities. Let's take a minute and just drill down into some of these companies and a little bit about their stories. This first one is a technology company, and what you're going to find generally in the Driehaus Fund is are overweights to technology, because in this growth strategy, there's a real focus on what we call new economy companies, new economy stocks that are really positioned to innovate and drive growth in the future for the global economy. And Axcelis is one of them. You can see over the past 6 months up 56%, and they're in the business of facilitating the fabrication of semiconductors. And why is this exciting? Well, we know how important semiconductors are to just about everything we do in life and in technology on a daily basis. But keep in mind, one of the biggest themes coming out of COVID, as well as the Trump era China trade embargoes, and that was supply chain disruption. So now there's a lot of conversation about onshoring or reshoring, especially as it relates to manufacturing and manufacturing of technology in one particular space, semiconductors. And as we all know, Taiwan is one of the biggest manufacturers of semiconductors today, and there's an enormous threat from a macro standpoint by China on the future of Taiwan, which is really uncertain. So this notion of manufacturing semiconductors and chip technology in the US is extremely important, as opposed to just importing all of our chips, and Axcelis is at the forefront in that area. So very exciting play inside the portfolio. This next one, WillScot Mobile Mini Holdings, this one would be considered a play in the infrastructure or industrial space. And in the US, we have this massive shortage of home construction. In virtually every major city in the US, you see just this incredible run up in home prices and in the rental markets. So there's a building frenzy that's taking place in the US. And if you've ever driven by a construction site, you see that it looks like almost a mini city with all kinds of trailers and accommodations for workers and a whole variety of infrastructure that sprouts out almost overnight. And it's not the construction companies that put that together. It's not the construction companies who own all those materials. They rent them from a company like WillScot Mobile Mini Holdings, who basically turns that construction job site into a mini city in a matter of weeks as they prepare for the construction that's about to take place. So a real growth market, and this company has exhibited dramatic earnings acceleration in earnings growth, and that's why we've seen the appreciation of about 25% over the past 6 months. So very interesting company. This next one, Axon Enterprises. This one's all about the hot topic of the day, which is cybersecurity, right? We all hear about that. Many of us have experienced cybersecurity issues on, say, our own credit cards or identity theft. So Axon Enterprises is a big tech provider. They provide the technology, they provide staff servicing to detect cybersecurity, they train people on cybersecurity. And they're also in the business, interestingly, of providing law enforcement with non-lethal technology. Now, I'm sure that I hear this frequently, that everyone thinks the US with its gun control problems and, quote, police brutality is the wild west of violence, right? And this company, Axon Enterprises, is also the owner and manufacturer of tasers, which is that non-lethal technology, and body cameras for police forces as well. So a very relevant technology-oriented company in both cybersecurity and non-lethal police services. And the very last stock that I'll touch on here, you have Celsius. Yeah, Celsius Holdings. So we just talked about violence as a problem in the US and how that's being solved by one company that's in the portfolio. Here's another problem that we face in the US. Over 40% of Americans are obese. I don't know what the other global statistics are, but in the US, we're turning into a bunch of fatties. And this is an interesting company because they're a beverage company, and they produce this beverage that actually helps burn calories. So it's not an energy drink. Don't think of it as something that's just got a lot of caffeine in it. This is actually a healthcare product that helps individuals. It boosts their metabolism, and it actually helps burn calories. And most recently, 8% of the company was bought by PepsiCo when it was in the portfolio, and they paid over $500 million for just 8% of the company. And this company over the past 6 months is up almost 13%. So some really interesting, innovative, new economy type companies that you're seeing in the portfolio. And this very last slide shows the impact of what an investment in these kinds of companies can have in your traditional balanced fund. I'm sure many of you use DFMs or balanced portfolios, and typically the stocks, the equities in that portfolio are in the mid-large mega cap space. You don't see much in the way of small cap small cap investment funds inside of these balanced portfolios. So we took a look at, well, what happens if we just add, say, 10% to one of our balanced products? We looked at it, say, on a year-by-year basis over the past 10 years. And you can see in the lower right-hand box there, the performance of the VAM Balanced Fund was up a respectable 32%. The small cap growth fund was up almost 200%. So when you blend in, say, that 10%, which doesn't significantly increase volatility, but adds a dramatic amount of alpha to the portfolio, you've increased the performance of the balanced product to almost 50%. So this is an example of sort of that a little dab will do you, where just a small percent addition of the VAM US Small Cap Growth Fund to any balanced fund that you're doing can add a significant amount of return without adding a significant amount of risk. But that's a quick overview of thoughts on macroeconomy and the VAM Small Cap Growth Fund. Steve, I'll turn it back over to you to talk about some of the particulars of the fund, share classes, etc.
Many thanks, Rob. So the US small cap is available in a retail share class, which is B, and that's got a 175 annual management charge, and that pays a trail to Lawson's. And also you have the ability to take up to 4.5% initial commission on that as well. Then we have the E share class, which is our institutional share class with a reduced AMC, no trail, but also you have the ability to take up to 4% initial commission on the E share class. And then this week we've just launched the Z share class as well, which is our back end charge. So that's 100% allocation for the client, 4% commission plus trail with a 1.75 AMC, and that's got a 54321 exit penalty. So we've got we've got a retail share class, pays a trail up front. We've got an institutional share class, no trail, but you can take up front. And then we have the back end share class. And all the share classes, minimum investment with $10,000, available through all life company platforms and offshore bonds. And I would say if these are USD funds, if you are looking for a GBP exposure, we also have the VAM US mid cap, which is managed by the same firm, and that's got a GBP share class as well. So that's all your options are on the small cap. Is there any questions at all coming from anybody on the call? Sarah, is there any questions that you've seen?
No questions have come in yet. If anybody does have any questions, please drop them in the Q&A box and we'll be able to pick those up and get right back to you.
And of course, we're happy to follow up individually with anyone who would like sort of a more detailed conversation.
Yeah.
Excellent. So yes, if there's any follow-up questions, then please dive into our provider matrix and pick up Steve's contact details. Oh, we've got one coming in. So this is from Sylvia. What is the volatility of the small cap fund?
So good question, Sylvia. So the fund has a beta of less than 1, which is extremely important. It has a beta of just over 0.8, because that means that it's going to deliver less volatility than the overall market. So slightly less volatility than the market with significant upside capture.
Great, thank you.
Oh, one more, I see.
Sylvia sending a thank you.
Oh,
That's perfect.
All right,
Thank you,
then.
Sylvia.
Well,
If there aren't any more questions, then Steve's contact details, we've got your email and contact number. Please reach out to Steve with those questions.
yeah, that's super. And Sarah, shall I send you the presentation that maybe you can?
Please, yes, if you send the presentation and then I can distribute that to our members. And I'll also send a follow-up with the recording as well.
Okay, super.
That's great. Well, thank you very much for joining us today, Steve and Rob.
thank you
Really
for everyone's
appreciate
time.
Yeah,
Appreciate it.
thanks for
Okay.
organising it. Appreciate it.
All right.
Take care then.
Bye, everybody. Thanks
Bye.
for attending. Bye
Thank
now.
you.
Mhm.